Hi, hello everyone. I wish a good day to all the viewers. So we have successfully completed our first session regarding legal framework, and now we are soon going to enter into the residential status. Upon introduction of new Income Tax Act 2025, how the provisions of residential status were being changed. So that's what we are going to discuss in today's session. So with no loss of time, let me begin the session. First of all, what is the importance of this session? Here we are categorizing the residential status into three parts. So I am categorizing them into three parts. The taxation of the income will depend upon the residential status of the SSE. Here if you observe, so here three parts have been specified: resident and ordinary resident, resident but not ordinary resident, and non-resident. So 3 points have been specified here. Here the residential status will decide the tax liability. Residential status will decide the tax liability because resident but not ordinary resident, because I have categorized the incomes into 8 categories were being specified here. Whether these 8 categories, in whose hands it will be taxable, whether it is taxable for ROR, RNO or NR, that means resident and ordinary resident, resident but not ordinary resident, and non-resident. So here what we need to learn, so incomes were categorized into 8 points. These 8 points were taxable for ROR or exempt for RNOR or not taxable for NR. These aspects we need to learn. So that's why first we need to determine the residential status. Once the residential status is determined, then we can know the taxability of the income. Whether the income is taxable or not, it depends upon the residential status. If you observe, for resident but not ordinary resident, there are 3 items which are not taxable, and for non-resident there are 4 items that are not taxable. That's why here first what we need to learn here is when a person will be called ROR, when a person will be called RNOR, and when a person will be called NR. These aspects we need to take clarity. So for the next 10 minutes, first let us focus on the residential status. So here residential status, many will present this residential status in different ways, but how I am going to discuss to you here is based upon the nature of the person I am going to categorize. Here if you see, the residential status of an individual being an Indian citizen. So for Indian citizen, the residential status we have different forms to determine the residential status. His presence in India, in some cases they say 182 days, in some cases they will say 60 days, in some cases 4 years 365 days. Those aspects I am going to clarify here. Before discussing this aspect, the material regarding this residential status is available in the description box, so you can download so that it will be useful for your reference. So first of all, how to determine the residential status of an Indian citizen? For Indian citizen, what they have specified here is if he is a crew member of Indian ship, that means who works on ship. If he is a crew member, there will be use of many members in the ship. So if he is a crew member of the ship, then he has to be in India for 182 days to become a resident. So Indian citizen, if he is a crew member, if he is working in a ship, that means foreign going vessel, the ship delivers the goods outside India and comes back. In that ship he is working. If the Indian citizen is a crew member of the ship, then for 182 days or more he should be in India to be a resident. And now coming very important aspects, when any person is leaving India for the purpose of employment, when any person is leaving India for the purpose of employment, they got employment at US, they got employment at UK, they are leaving India. In this case, to become a resident in India, he should stay minimum 182 days. Sir, why we are determining the residency status? Residency status will determine the liability. Actually, a person going for employment outside India, here we are encouraging. So, because here we have unemployment facilities, or even the employment facilities are available, the salary might not be sufficient to them. That's why many people are moving to abroad for their jobs. The person who is going outside India for the purpose of employment, we need to encourage them. That's why to give non-resident status, we are specifying a condition that he should be in India for 182 days to become a resident. That means if he is in India for less than 182 days, he will be called as a non-resident. For non-resident, foreign incomes will not be taxable in India. For non-resident, only Indian incomes will be taxable. Foreign incomes will not be taxable. That's why to encourage him, we have specified that he should be in India for 182 days during the tax year to become the resident. So finally speaking, Indian ship crew members, they should stay in India for 182 days to become a resident. And a person leaving India for the purpose of employment, he should stay in India for 182 days to become a resident. Here we are encouraging him, because if he goes for employment outside India in August or September, that means April, May, June, July, only 4 months he is in India, which is less than 182 days. So we call him as a non-resident. What happens if he is a non-resident? For non-resident, foreign incomes will not be taxable in India. Only Indian incomes will be taxable. That's why we are categorizing here. Coming to the next one, very important thing. A person is residing outside India. Which person? Nothing but Indian citizen. Sir, first of all, I have a basic question. What do you mean by Indian citizen? How can you determine a person as Indian citizen? In second page, I have given you clarification. Citizenship Act 1955. Section 3 has specified that if he has taken his birth between 1950 to 1987 1st July, then if he has born in India, if he has taken birth in India, he will be called as Indian citizen. But if he has taken birth between 1987 to 2004, along with him, one of his parents should take birth in India. He has to take birth in India. In order to become Indian citizen, his parent also should take birth in India, any one of his parents. Then he will be called as Indian citizen. If a person is born after 3rd December 2004, then when he will be called as an Indian citizen, both the parents should be Indian citizens, or at least one parent is enough, but he should not be an illegal migrant. That means there should not be any cases lodged against him regarding this immigrancy. That means going outside India or coming to India. Either one of the parent, actually on or after 2004, both the parents should take birth in India to become a citizen. Their child to become a citizen, both the parents should take birth in India first of all. But here what they have specified is one parent is enough on a condition that other parent is not having any illegal migrant status. So based on valid visa, valid passport, they have to go to outside India or come to India. Then only one parent is enough. Okay. So here what we have decided here is Indian citizen. So when a person will be called as Indian citizen means usually if he takes birth in India. Now coming to the thing, person of Indian origin also this section is applicable. So what do you mean by the term person of Indian origin? If a person was born in undivided India, that means before 1947, India, Pakistan, Bangladesh, all are of part of India only. So if he was born in undivided India, or his parents or grandparents also, either parents or grandparents were born in undivided India. For example, if in 1940, if Mr. A grandparent has born in Karachi, his grandparent has taken birth. Now, whether Mr. A's grandfather has taken birth in Karachi in 1940. Now, in this year 2026-27, whether Mr. A will be called as Indian origin? Yes. Okay. So, this is person of Indian origin. So, I have clarified the difference between Indian citizen and Indian origin. So, here for the first 2 points they have specified only Indian citizen, but for this third point, Indian citizen or Indian origin, where they are usually residing, they are residing outside India. Why that person is residing outside India? He might not have employment there, or for the purpose of doing a business he might have gone there, or for the purpose of education he might have gone there. So he has went outside India, he is residing outside India, he is habitually located outside India. So such person comes to India on a visit during the tax year. He is coming to India for a visit, there is any function, or to meet his parents, or to meet his friends, whatever may be the reason, he is coming to India during the previous year on a visit. Then what happens in this case? Whenever he is coming to India on a visit, then to become a resident, he should stay in India for 182 days. For a short visit of 60 days or 70 days, he will not be called as resident, he will be non-resident only. So these two cases were included in 180 days to give benefit to them only. Okay. So Indian citizen, crew members of Indian ship, 182 days they have to stay in India to become a resident. A person leaving India for employment outside India also, they should stay 182 days in India. Indian citizen or Indian origin, when he is coming to India on a visit, this one going outside India, this one coming to India on a visit. So in this case also they will be treated as Indian citizen on a condition, they will be treated as resident if he is in India for 182 days or more. So till here I have clarified. So this is this amendment has come into effect from Finance Act 2020 onwards. So this amendment most of the persons still were unaware. Even in new provisions also, New Income Tax Act section 6 also deals with the same. So let us have a discussion with an example here. What the example I have specified here is, I have categorized into two parts. Special point which I am discussing now, which I am going to discuss now, is a special point. Yeah. Holiday visitor. Holiday visitor. Sir, here I am saying visitor means, what do you mean in this case? He is usually residing at India or outside India? He is residing outside India, since I am saying visitor here. So, for example, Rahul is an Indian citizen. We are discussing the provisions applicable to Indian citizen only. So, Rahul is an Indian citizen who is living in London. So, he earns 10 lakhs from a rental property in Delhi. He earns 10 lakhs from rental property in Delhi. He comes to India for 150 days to help his parents. So, till here if we listen, what we have come, the things which you have learnt earlier. Since he is coming to India on a visit, Indian citizen coming to India on a visit, he should stay in India for how many days? 182 days is our condition which I have told earlier. But now what I am saying here is, when the income, here he is a non-resident, okay, based on our current discussion he is a non-resident. But here what they have specified here is, if this Rahul is a high earner, if this Rahul is a high earner in the sense, if his income is greater than 15 lakhs, then this 182 days should be replaced with 120 days. That means if he is in India for 120 days, he will be called as a resident. So an Indian citizen having income greater than 15 lakhs. Here income means Indian income only. That means excluding the foreign sources. Excluding the foreign sources. Indian income only we are considering here. So if the Indian income is greater than 15 lakhs, here if you see an example, Priya is an Indian citizen living in Dubai. So she is living at Dubai. Her residence is at Dubai. She has a fixed deposit and also stocks in India that earn 20 lakhs per year. So in India, how much income she is earning? 20 lakhs income she is earning. Even though she is at Dubai, she might have many incomes at Dubai. So whether that Dubai incomes will be taxable in India, that I am not saying. Whether it is taxable or not depends upon the residential status. If she is resident and ordinary resident, we will discuss the additional conditions also. If she is resident and ordinary resident, even foreign income also will be taxable in India. Of course, double taxation avoidance agreement benefits can be taken, which is a separate thing. But here, let me complete my discussion. So, here she is getting 20 lakhs per year in India. She has visited India for 140 days. Usually what we will say is, since she is an Indian citizen, she should stay in India for 182 days to become a resident. But here, what I have specified here, for 140 days only she is in India, but her income has exceeded 15 lakhs. Since her income have exceeded 15 lakhs and she has stayed in India for how many days? 120 days. Plus there is another condition that for the last 4 years she should stay in India for 365 days. Last 4 years, how many days she has to stay in India? For 365 days. A person passport will decide how many days he has stayed in India. So, passport, whenever the stamp is being levied by the Indian passport authorities, so whenever they got entry into India, immigration is going to put a stamp on the passport. That stamp date is also part of India. Okay. So, here based on passport we will decide the number of days. So, last 4 years, how many days she should stay in India? 365 days. Plus in current year, how many days she is in India? 120 days. So, she will be called as resident. Ordinary or not, we will decide. Within a span of 5 minutes, we will decide. So, first of all, what I am saying here, she will be called as a resident. First, let me come back. Let me go back to the provision. Here, if you see, a person of Indian citizen or Indian origin, when the total income is greater than 15 lakhs and they stayed in India for just 120 days plus last 4 years 365 days if they stay in India, then they will be called as, I have put arrow mark here, then they will be called as resident. Till here is it okay? Sir, what happens if income is less than 15 lakhs? 182 days aspect has to be taken care here. I have put here 182 days or more, they have to stay in India to become a resident. Am I very clear here? So, all these provisions for whom they have specified here, Indian citizen. Actually, many people confuse by presenting this number of days. Rather than confusion, I have taken the person status here based on which I can give you a complete clarification on number of days. Here I have taken Indian citizen as the base. So, crew members of the ship, they have to stay 182 days to become a resident. Person living in India for the purpose of employment. There are many judicial pronouncements that this employment includes self-employment also. Even for the purpose of doing any business, he has went outside India. Then also this 182 days only we have to take into consideration. And coming to the next one, Indian citizen or a person of Indian origin, that means he is residing outside India. He is coming to India for a visit, whatever might be the purpose, visit is official purpose or personal purpose. To become a resident, he have to stay in India for 182 days. Keeping all these three things set aside, high earners, even though they are residing outside India, high earners will be treated as resident in India for how many days if they stay in India? For 120 days and last 4 years 365 days. I am terming them as high earners. High earners means Indian income should exceed how much? 15 lakhs. We should not include the foreign sources, only the Indian sources should exceed 15 lakhs. And coming to total income, if it is less than 15 lakhs, 180 days concept only we will take up. Till here is it okay? These are the provisions which were applicable to whom, sir? Indian citizen. He is living outside India or coming to India on a visit. For that purpose I have specified here. Sir, take me as example. I am residing in India, but I am interested in foreign tours. So, many days I visit outside India for the purpose of tour. For me, how will you decide? In all these cases, if you see, he is going for employment outside India, but I am going for tourism purpose outside India. Coming to India on a visit, for whom? Residing outside India, but my residence is at India only. Habitually, I will be at India only. For tour purpose, I am going to outside India. How my residential status will be decided? Here, two conditions were specified. When any one of the two conditions is satisfied, I will be called as a resident. In the previous year, that means here previous year means nothing but now tax year. In the tax year 26-27, they have to stay in India for 182 days, or in the previous year I am in India only for 60 days, but last 4 years I am in India for 365 days. Then I will be called as a resident. In between, the point used here is or. That means among these two, any one condition is satisfied, that is enough. Then I will be called as a resident. I hope the concept is very clear. So generally, that means who are Indian citizen, who is not only Indian citizen, even non-resident also. Generally, what is specified here? That means abroad persons also, foreigners also. When they will be called as a resident, they have to stay in India for 182 days, or in tax year 60 days only, but last 4 years 365 days if they are in India, any one of the conditions is satisfied, then they will be called as resident. So till here the concept is, I hope the concept is very clear. So this first part has exclusively focused on Indian citizen. First part I have exclusively focused on Indian citizen. In second part, so I am generally focusing on any person. So foreigners or the persons of India, whoever may be. So here he is in India for 182 days or more during the previous year. So now let me continue. Among these two conditions, in middle the term used is or, then he will be called as a resident. Now there is a special case. Since the basic points have been discussed, this special case is very useful to us. Usually an Indian citizen or origin person, when the income is greater than 15 lakhs, I have termed them as high earners. We are using the term high earners. That high earners, if they stay in India for 122 days, they will be called as, if they stay in India for 120 days plus last 4 years 365 days, then they will be called as resident. But here comes the special case where even though he is in India for less than 120 days, he will be called as a deemed resident, section 6 subsection 7. In old income tax act, it was section 6 subsection 1a, very important provision. When the Indian income is greater than 15 lakhs, here total income means nothing but all the incomes except foreign sources. In next step, I will tell 8 categories I have said to you now, sir. In the beginning of the session itself, I said there will be 8 categories. Out of those 8 categories, first 5 categories only will be considered. So at present, please forget about those categories. Simply Indian income should be considered, excluding the foreign sources. So if the Indian income is greater than 15 lakhs, sir, here in this case, that person is less than 182 days or 120 days. This 182 days he is less than in India, or even 120 days also he is not in India. Then also he will be called as a resident. Why? When the income is greater than 15 lakhs. Sir, you said no, even though when income is greater than 15 lakhs, 120 days they should stay in India. But here is an exception that even though you are residing for less than 182 days or 120 days, you are having a income in foreign country, and that foreign country is enjoying tax free status there. As per domicile or residence or other criteria, you are not paying any tax in the other country. That means that foreign income will you tax to me, sir? Foreign income I am not taxing. Indian income 15 lakhs will be taxable if you are ROR. Sir, even for non-resident also, if 15 lakhs is earned in India, it will be taxable only now. But for resident and ordinary resident, there is a special point that even business carried on outside India also, if it is controlled from India, it will be taxable. Next, I will discuss those 8 categories. There we will get a clarity. That's why keep all other doubts aside till now. What I am specifying here is, with one example, we will get a clarity. Regarding this foreign country not taxing the incomes, those aspects also I will give you with a perfect example right now. Yeah. Let us see this perfect example. Say a person named Vikram, status Indian citizen, he is holding an Indian passport also, okay. He works in Dubai as a software architect. In Dubai, he is getting 80 lakh salary, and in India, he is getting 20 lakhs rental income in Mumbai, and also he have fixed deposits, interest income. So total income is 20 lakhs in India. So in previous year, he is so busy and he did not visit even a single day. In single day also he didn't visit India. Now let us see this case. So in this case, usually what we will say, Indian citizen, either 182 days he should stay in India to become a resident, or since he is a high earner, 120 days plus last 4 years, 365 days he has to stay in India. But in last year he is not even 120 days in India. He didn't come to India at all. So what we will decide him as a non-resident, we will say usually. But here comes the exception. When your income is greater than 15 lakhs and in Dubai your salary of 80 lakhs is not being taxed at all. Why it was not being taxed? As per laws of that country, there is no income tax at all. So Vikram stayed in India for 0 days. He is not a resident under normal 182 days or 60 days rule. But Old Income Tax Act section 6(1)(a) and New Income Tax Act, it is section 4(7), and it was section 4(7). So here what has been specified here? So what has been specified here is his Indian income is greater than 15 lakhs. Yes, it was 20 lakhs. Is he liable to pay tax in Dubai? No, because UAE does not tax any personal income salary. So what is the result in this case? In this case, Vikram is deemed to be the resident of India despite 0 days. Even though he is not in India also, he will be deemed to be resident because he is not having any tax in Dubai. Sir, here what is his total income? 80 plus 20, 1 crore. This 80 lakhs we will not tax it, sir. Please remember. We will tax this 20 lakhs only. But what we have decided, his residential status as resident. His residential status I have determined it as resident. Am I clear? But he is resident but not ordinary resident always. There are no additional conditions in this case. This deemed resident will always be classified as RNOR, the resident but not ordinary resident. So what? If this person, Vikram, is having business outside India, if this person is having business outside India, but it was controlled by his cousin. For example, he is having business at Australia, but he is not taking care of that business. He has only invested in the business. That business is being controlled by his cousin. That business is being controlled by his cousin. This cousin is a resident of India. That means even though business is located outside India, it is controlled from India. In this case, even though the business income is received outside India, for RNOR, resident but not ordinary resident, this will be taxable. Usually, since he is in India for 0 days, if we call him as a non-resident, these types of incomes cannot be taxed. These type of incomes cannot be taxed. Let me show you the category so that we will get more clarification. See here. Income accrued and received outside India from a business controlled from India. Where is the business? Business is outside India only, but it is controlled from India. This is taxable for RNOR and it is not taxable for non-resident. If we don't say this deemed provision, deemed resident concept is not said now, then what happens? This income might not be taxable in India. This income might not be taxable in India. That's why we are categorizing him as a RNOR because he is an high earner. And in foreign income, he is not paying taxes at all. That's why we are going to categorize him as a resident. Sir, whenever he is resident but not ordinary resident, then what happens in this case? If the business is controlled from India, it will be taxable. But in this case, he has received 80 lakh salary income. Salary income we are not taxing. Salary income, any other income accrued and received outside is not taxable for him also. We are not bothered regarding salary income. If he does any business outside India, to tax that incomes in India, what we are doing here is, we have introduced this concept of deemed resident. We have introduced the concept of this deemed resident for that purpose. If the total income is greater than 50 lakhs and he is not paying any tax in other country by reason of his domicile, residence or other criteria, then what happens? So, for them, in order to tax the business which was controlled from India, this new aspect has come into existence. Let me conclude the example. Sir, for our understanding sake only, I am giving these examples so that even in future if you refer also, the concept will be quite clarity to you. Whenever you listen, you take up the material in future also. So, whenever you see the example, we can remember the entire concept. So, 20 lakhs taxable in India, yes, because it is earned in India. What about 80 lakhs? It is not taxable because his RNOR, foreign income, will not be taxable in India. But what will be taxable? If he has, in this example, he is not having any income. Here we have categorized him as RNOR. Why we are categorizing him as RNOR? If he has any business outside India, but controlled from India, then in this case, this business income is also taxable in India if he is RNOR. That's why we are classifying him as RNOR. Hope the concept is very clear. If Mikram moved to a country like Germany or USA, where he pays local tax, this deemed resident rule would not apply to him. Why we are applying this deemed resident rule? Because in that country, if he is tax free or low tax jurisdictions, significant earnings will come back to India. That's why we are going to levy this, we have introduced the concept of RNOR for deemed resident. Hope the concept is very clear. Now let me conclude the provisions. So till now what we have learnt here is, we have just classified a person as a resident or non-resident. In this one deemed resident case, have also classified whether ordinary resident or not. Resident but not ordinary resident, here it is fixed. Till now we have learned till here. Now let me continue my discussion. Here, what is the additional point that was specified here is, after you are deciding a person as a resident, you have to decide whether he is ordinary resident or not ordinary resident, because in these two cases the taxability is different. That's why we have to categorize him as a ordinary resident or not ordinary resident. So how is it possible? If he is in India, for additional conditions have been specified. Here ordinary resident or not ordinary resident depends on additional conditions. What are the additional conditions that were specified? In last 7 years, he should stay in India for 730 days. And that means another condition should also be satisfied. What is that another condition? Last 10 years, 2 years you have to be resident. How we can know he is resident or not? Based on these conditions. Out of last 10 years, how many days he should be resident in India? He should be a resident in India for 2 years. Then he will be treated as ordinary resident. So here two conditions were specified. When both the additional conditions are satisfied, he will be called resident or ordinary resident. When any one or none of the conditions are satisfied, then he will be called as resident but not ordinary resident. So till here is the concept clear. So by this we have decided the residential status, and there is one more point here, sir. What I have said here is, for Indian citizen or Indian origin, if the total income is greater than 15 lakhs, what I have specified here is minimum 120 days if he stay in India, he will be called as resident. But along with resident, now we have to decide whether ordinary resident or not. So if he is greater than 182 days in India, he will be called ordinary resident. If he is between 120 to 182, he will be called RNOR. Sir, what happens if he is less than 120 days, sir? Then we don't know, non-resident only. In some cases, even though he is less than 120 days, if in other country he is not taxed, then the deeming provisions will come into existence. Am I clear, sir? So, Indian citizen having total income greater than 15 lakhs, if he stay in India for greater than 182 days, then he will be called not only resident but also ordinary resident also. But if he is in stay for 120 days, 122 to 182 days, then he will be called resident but not ordinary resident. So, we are classifying as 3 points here: resident and ordinary resident, resident but not ordinary resident, and non-resident. 3 points we are categorizing, because if the status of the person is these three, any one status if he is going to get, based on that status only income taxability will be determined. I have categorized income into 8 points, so there we will get more clarification regarding this aspect. So, is this first page very clear, sir? Analyzing all the provisions of number of days, I have presented in a most effective manner, so that we can get the concept very easily, we can understand the concept. So, for that purpose I have presented in this chart mode. I have categorized them into Indian citizen and general persons, so that we are going to get more clarity. So, by this we have completed residential status of an individual, we have completed. How to determine the residential status of persons other than individuals? How to determine the residential status of companies? Yeah, now we will decide. So, first let me begin with the residential status of persons other than individuals and companies. Individuals other than individuals and companies. That means, for example, let us take HUF as example here, or a partnership firm, let us take example. When it will be called as a resident? So, here if control and management of the business is wholly in India, it will be called resident. If the control and management is wholly outside India, then it will be called as non-resident. Partly in India also, it will be called as resident. That means, in order to take a complete status of non-resident, the control and management should be wholly outside India. Say partnership firm purely controlled from outside India. What happens in this case? It will be treated as a non-resident. A partnership firm having partly controlled from India, even part case also it will be treated as a resident. But in case of HUF, additional conditions were also being specified. Karta's presence shall be considered. If Karta satisfies both the additional conditions, that means last 7 years 730 days, last 10 years 2 years he is resident. So, if Karta satisfies both the additional conditions, then he will be called as ROR. When Karta does not satisfy any of the additional condition, he will be called as, HUF will be called as RNOR. So, generally for HUF, how we determine the residential status? Based on control and management, we will decide. After deciding as a resident status, then to decide ordinary resident or not ordinary resident, here we have to check the Karta's presence in India. If Karta is in India for 730 days, Karta satisfying additional conditions, then HUF will be called as ordinary resident. So, by this first 2 pages we have completed, and now coming to residential status of companies. How we will decide the residential status of companies? So, here if you see, Indian company is always resident in India. So, all the incomes of Indian companies, it might be a foreign branch also. Foreign branch profits also will be taxable in India. Sir, that foreign country also, since branch is located there, that country also will levy taxes? No. There is Indian branch and also Australia branch. This entire global income will be liable to tax in India. But for Australian branch, Australian country also will levy taxes? No, since branch is located in Australia. So, it suffers double taxation. Then the DTAA, double taxation avoidance agreement between India and Australia should be seen here. And after watching them, now what happens here is, if they come to a conclusion in double taxation avoidance agreement that the permanent establishment wherever it is located in that country only we have to levy taxes, then in that case Australia only they will levy taxes. In India we will claim exemption. based on the provisions of DTA. Separate form has to be filed to get the tax credit. Those aspects we will discuss later. There will be a separate chapter, double taxation avoidance agreement. There we will have a discussion. So now here finally speaking, Indian companies are always resident in India. Its global incomes will be taxable in India. If there is any foreign branch, again in foreign location, taxes were levied, then double taxation treaty benefits can be availed. Now coming to the next one, foreign companies. Foreign companies residential status will be determined based on place of effective management. What has been specified here? Place of effective management. So what do you mean by the term place? If place of effective management is in India, it will be resident. If place of effective management is outside India, it will be called non-resident. So now what we need to learn here is, what do you mean by the term effective management, place of effective management? Here, when the turnover is less than or equal to 50 crores. When the turnover is less than or equal to 50 crores. So what they have specified here is when the turnover is less than or equal to 50 crores. So place of effective management shall be the place where the key management and commercial decisions were taken. Main decisions where they are going to take forms the basis. If key decisions were taken outside India, then they will be treated as a non-resident. If key decisions were taken in India, then resident. This is for which companies? Foreign companies only. Indian companies always resident in India. But when the turnover of the foreign company is greater than 50 crores, then a separate circular was given. Clarifications were given. Here, the place of effective management will be decided based on manpower, based on payroll, the salary you are paying to them, based on assets located, based on board of directors meeting, based on holding and subsidiary company relations. So all these points have been clarified in this circular. Since it is more specific point regarding place of effective management, which is applicable only for foreign companies, those points I am not discussing here, because it is case oriented. Depending upon the case, we need to decide the place of effective management, for which I have given the reference. When any case comes in our practice, then we have to go based on the circular. Here, whether active business is in India or outside India, based on the assets located, they will decide. More than 50% of the assets were in India, then it will be called as a resident. Like that, the conditions were being specified. Board of directors, major meetings were being conducted in India, then it will be called as a resident. For all the companies, not same. Depending upon the nature of the foreign company, different points have been specified there. So if any case comes up, you can go through the circular and decide the place of effective management. Here what we need to get clarified here is, if the gross receipts is 50 crores or less, then key management decisions if taken in India, it will be called as a resident. Am I clear? So by this we have decided the residential status of companies. Now here comes the most important thing. For this point only, till now I have waited for discussing. Now I will clarify these points. This should also form part of our tool, sir. Actually, we have decided in first session itself, some toolkit we need to maintain so that we can easily suggest to our clients. This is one of those toolkit we can say. Because incidence of tax for resident and ordinary resident, for resident but not ordinary resident, or for non-resident. This is what we have decided till now. 8 incomes were given. Which income is taxable for which assessees, those things. Now let us take a clarification. Here many important points of Income Tax Act like Provident funds, contribution to them, employers contribution, employees contribution, pension funds, like this many special points which were useful in our daily routine practice also we will discuss here. Okay. So now coming to the thing, if income is received in India, sir, here what is in India? You have received the income in India. Sir, where did you earn the income? That is irrelevant. If you receive the income in India, your status might be resident and ordinary resident, RNO or NR. All the 3 cases this will be taxable. Sir, I have the income is accrued at US. In America, I have earned the income. Okay, then where did you receive? Have received in Indian bank account. That is enough for us. Since you are receiving in India, you pay the tax in India. Sir, actually, where did I earn the income? at US. Will the US country levy tax on me? Yes. So, based on earning status, US is levying taxes. And what you are specifying here is, since you are receiving in India, you are asking me to pay the taxes. That means, now I am liable to pay taxes both at US and also India, which amounts to double taxation. Then what we need to see here, double taxation avoidance agreement has to be seen. What they have decided for this case, if it is any royalty income or fees for technical service, interest incomes or any business incomes, for each type of income, there in agreement they have specified the terms. If they have decided there that based on accrual basis only it will be taxable, then as per Income Tax Act, if it is received in India, we are taxing. But DTAA prevails over Income Tax Act. So what happens? In DTAA they have said based on accrual status only tax liability will be. Then what happens in this case? In US only it will be taxable. So in India it will not be taxable. Double taxation benefit can be taken. There will be two methods here. Either exemption method, that means if it was taxed in foreign country, it will be exempted in India, that is exempted method. Or tax credit method is also there in DTAA. The tax paid in US can be claimed as credit in India. We will include that foreign income in India, levy taxes, out of those total taxes, whatever the tax you have paid in foreign country, converted into Indian rupees, we will give you tax credit. That is another method. Two methods of DTAA benefits are available, either exemption method or tax credit method, which we will discuss in detail in DTAA chapter. So now let me conclude here. What I have said here is, if the income is received in India, I repeat, if the income is received in India, irrespective of its accrual, all the 3 persons should pay the taxes. Next, income deemed to be received in India, even though you are not receiving in your bank account, even though it is not credited in your bank account, even though you are not receiving any cash, in some cases we deem that you have received the money. Sir, what are those cases? We will listen, we will take next after completing this one. Here itself I have given income deemed to be received in India, there we will decide. First, let us have a clarification on these categories so that my further explanation will be very easy to understand. Now coming to next one, income accrued in India, whether or not received in India. First point focused on receipt, whereas third point focused on accrual. If accrual itself is in India, if you are earning income in India, then even though you are receiving outside India also, since the income is accrued in India, where did you earn? In India, sir. Then in such case, whatever is your status, you will be liable to pay tax in India. Sir, foreign country is also levying tax, sir. Then what we need to do? We have to compare the DTAA and then we have to either follow exemption method or tax credit method. This sentence is common for all the things. Again and again I will not repeat. So now let me conclude. When the income is received in India, what is the conclusion? Taxable for all the SCs. Income deemed to be received also taxable for all SCs. Income accrued in India, taxable only for all the SCs. Here also taxable for all the SCs. Since it was accrued in India, receipt is not the criteria. Income deemed to be accrued, very big topic to be discussed. Very, very huge topic. Even in Bayer Act itself, it was 7 pages. Bayer Act itself 7 pages means, to understand how many pages we need to learn. Deemed to be accrued. There is a special concept called significant economic presence in India. Sir, if there is a branch in India, foreign company only, if they are establishing a branch in India, nothing but permanent establishment in India, whether that branch profits will be taxable in India or not. If a foreign company is putting up any branch in India, whether that branch profits are taxable in India or not, obviously yes, because it was accrued in India. But here what they are specifying is, even though you are not having branch in India, if all the sales or services were provided online only, everything, the transactions were being done online, through over a phone call or through mails, through internet, everything it was done, then what has been specified here? If your economic presence in India, not physical presence, if there is physical presence in India, you will be taxable, no doubt. Even though there is no physical presence in India, A new concept called economic presence has come into existence. Number of users, more than 3 lakhs users if you are having, or amount wide if you are receiving more than 2 crores, then it will be taxable in India, they have specified. That significant economic presence aspect is very important for our discussion. Many examples I have given, sir, around 13 to 15 examples I have given in this material itself. We can easily understand this concept of significant economic presence, because nowadays, sir, from Corona time onwards, sir, many were staying in India, and they are providing services to a person outside India, and foreign income is being created in the bank account. There might be reverse situation also. They are staying outside India and they are earning in India. They are earning income from the users in India. So in this case also, in some cases, tax liability might arise. How the liability arises, that's what we need to say. Significant economic presence should be in India. That is discussed in income deemed to be accrued. Very special topic for discussion. Sir, in all these 4 cases, what is the common thing? In all these 4 cases, what is the common thing? Either receipt is in India or accrual is in India. Since either receipt or accrual is in India, for all the 4 persons, for all the 3 persons, we are taxing the income. So finally, income received in India, income deemed to be received in India, income accrued in India, income deemed to be accrued in India. These 2 points we need more discussion, sir. 2 and 4 we will discuss. But till here, if we say all these 3 persons, all these 4 incomes will be taxable. Now coming to 5th one. Sir, in first 4 points, either accrual is in India or receipt is in India. But from 5th point, receipt will be outside India. Accrual also will be outside India. But if it is a business income which is controlled from India, or a profession where initial setup is in India, in this case, it will be taxable for ROR and RNOR. Sir, strictly speaking, where is the business? In 5th point, where is the business? Business is in India or outside India? Business is outside India only. If business is in India, it was accrued in India, comes under 3rd category. So what I am saying here is business is outside India. Received and accrued outside India. But from where you are controlling the business? India. Control may be financial control, or authorized representative, a person you are appointing, he is only completely controlling the business. You have given GPA to him and he is controlling the business from India. That will also be taken as a control. So, business controlled from India or profession set up in India. In this case, for ROR and RNOR, this will be taxable. Only for non-resident we are leaving. Remaining 2 cases, this will be taxable. Hope the concept is very clear. In 5th point, even though accrual and receipt outside India, what is there in India? Control is there in India. But in 6th point, if you see, even business is also controlled from outside India, then what happens? Sir, business is outside India, receipt outside India, accrual also outside India. Then why to tax in India, sir? But he is ordinary resident. He has stayed in India for last 7 years, 730 days. Out of 10 years, he is 2 years resident in India. So, since he is ordinary resident, we are taxing him. Sorry, foreign country also levies tax. Again, DTA. We need to remember. Am I clear? So, income accrued and received outside India. Sir, 5th and 6th point, please understand the aspect here. In 5th and 6th point, common thing is business is outside India. Accrual and receipt outside India. But in 5th point, business is controlled from India. And in 6th point, business is controlled from outside India. When everything is outside India, why you are taxing, sir? But he is ordinary resident. He has a pure physical economic relation in India. That's what we are specifying here. Since he is more number of days he is residing in India, we are taxing him. Am I clear? Sir, 5th and 6th point focuses on business incomes only, business or professional incomes. That means chargeable under the head, business head only. But 7th point is any other income like salary, house property, capital gain or other sources. All the other incomes accrued and received where? Outside India. If it is accrual is in India, category 3. Receipt is in India, category 1. Here both are outside India and the income is other income. In this case also, we leave RNOR and NR, but we tax ROR. Sir, when other income is earned outside India, why you are taxing me, sir? Because you are an ordinary resident. Am I clear? And eighth is very, very important. Many of the clients will ask us, in foreign country they have earned the income. So, for example, one person, Mr. A, or father of one person is my client. That father is asking me, my son went to abroad, there he has earned income, he wants to transfer me 1 crore. He wants to bring 1 crore to India, either to his bank account or father bank account. If it comes to father bank account, it is a gift. Gift among relatives is not taxable at all. If it was brought directly to his bank account, then what happens in this case? Is it taxable? No, because it is earlier income. It was remitted to India during this year. The past year income, if comes to India during the previous year, it is not taxable in any case. In any case, this will not be taxable at all. When earlier income is remitted to India during the previous year, in any of the case, this will not be taxable at all. That is what the clarification given. Hope the concept is very clear, sir. Total how many categories I have divided? 8 categories. 8th category is income of earlier years or even current year also, sir. If it is brought to India during the current year, when it is current year income, we will categorize under these 7 points and decide taxable or not. That's why that income if remitted to India, first of all, 8th point is where the income is received outside India. Now what has been done? Remittance is only done now. So that remittance is not taxable at all. That's what the clarification has been given here. So all these incidents of tax have been specified in section 5. So by this, we have completed these categories. Now let me move on to the next provision. So income deemed to be received in India. So we have to learn in detail this second and fourth points, sir. Income deemed to be received in India and income deemed to be accrued in India. These 2 points we have to learn in detail. So here now we will learn income deemed to be received in India. For this purpose, we have to learn the concept of Provident Fund. If we learn the concept of Provident Fund, we will get more clarity. In the 12th page I have given the treatment of Provident Funds. First, types of Provident Funds, let us see. Provident Fund is nothing but saving. So at the time of retirement, that will be useful. We will get money. During the period of employment, we can get interest also on that Provident Fund. For this Provident Fund, both employer and also employee will contribute. So Provident Fund are of four types: statutory Provident Fund, recognized Provident Fund, unrecognized Provident Fund, public Provident Fund. Like this, Provident Fund I have categorized them into 4 types. Statutory Provident Fund will be maintained by government only. So our role is to just employer and employee should contribute to that Provident Fund. Government only will maintain that Provident Fund. Next, recognized Provident Fund. Sir, if there are many lakhs of employees, rather than making payment to government and future at the time of settlement, so again approaching the officer, making a separate claim and then getting it as refund, these things takes time. Since we are only having more than 1 lakh of employees, for example I am saying, since we are having more number of employees, we can maintain our own Provident Fund, no. But that Provident Fund will have conditions where you have to deposit these proceeds, where you have to invest these proceeds. Conditions will be given by the Provident Fund Commissioner. If the conditions specified by the Provident Fund Commissioner were satisfied by us, then we will get a recognition, and that Provident Fund maintained by ourselves is called as recognized Provident Fund. That means recognized Provident Fund is not maintained by the government. It is maintained by the employer only on conditions given by the Provident Fund Commissioner. Provident Fund Commissioner rules and regulations only he is following. Then it will be called as a recognized Provident Fund. So Provident Fund I have categorized them into two types: statutory Provident Fund and recognized Provident Fund. Now coming to the next one, unrecognized Provident Fund. The conditions given by the Provident Fund Commissioner are not satisfied. then automatically it becomes a unrecognized provident fund. Sir, shall we encourage this unrecognized provident fund? No. That's why contributions cannot be claimed as deduction. Interest accrued also will be taxable. We'll discuss next. Next, public provident fund. Here there is no concept of employer. You have to deposit on our own. Public provident fund. Even me having professional income, can I make deposit to public provident funds? Yes, PPF accounts maintained in all the public banks and also post office. PPF account will be there. Contribution to PPF, earlier Income Tax Act under section 80C and in new Income Tax Act under section 123, we can claim deduction in old regime also. Deduction is available only for old regime opting only. New regime, these deductions are not available. So finally, I have categorized them into 4 points: statutory provident fund, recognized provident fund, unrecognized provident fund, and public provident fund. So 4 points have been specified here. So for these 4 provident funds, how the taxability will be? This is what now we need to decide. Very important aspects, sir. Even for at the time of assessment of salaries also, this will be useful to us. So statutory provident fund, recognized provident fund, unrecognized provident fund, public provident fund. 4 points have been given here. Now let me start. Employer's contribution. Sir, who is contributing here? Employer is contributing. But this contribution will be benefited to whom? Employee. This contribution will be benefited to whom? Employee. So here employee, in hands of employee, it is exempted. Employer's contribution will be added to the salary first. Since employer is contributing to the employee benefit, it will be treated as a perquisite and it will be added to the salary first. However, since employer is contributing to statutory provident fund, it is exempted. Sir, what happens if employer contributes to recognized provident fund? It is also exempt since you are maintaining on your own. The contribution to the extent of 12% of salary is only exempted in this case. Contribution to the extent of 12% of salary is only been exempted in this case. So more than 12% of salary if they receive, then it is not exempted. Contribution to the extent of 12% of salary is only exempted. I have many examples here. Even there, the limit of contribution 7.5 lakhs is also there. Let us discuss those aspects. Sir, once again I am saying how the contributions will be taxable, we need to learn. Why we are learning this topic in residential status? Because the taxability will depend upon, whether DMUT to be received or not. That's why in order to understand that concept, first we need to learn this one. Here let me show you, sir. Recognized provident fund, when employer contributes, that will be treated as a perquisite under old act and also new act section 17 only. It will be treated as a perquisite. But the primary rule here is up to the extent of 12% is only exempted. So up to the extent of 12% of your salary, basic plus DA, out of which 12% will be calculated, or any commission we receive, that we also will add into salary and we calculate 12% here. Till here is it okay? Now let me continue. The excess above 12%, Sir, if employer contributes 15%, then what happens? Exemption will be, salary let us assume 1 lakh. How much will add to the salary? 15,000 will be added since he is contributing. Out of which exemption is restricted to 12,000 only. 12% only we will have restriction exemption. So balance 3,000 will be taxable, which will be treated as deemed to be received in India. Because here this 3,000 did we receive? No. It was contributed to RPF. Even though we are not receiving now, it will be deemed to be received in India. It will be deemed to be received in India. So this is the first aspect of income deemed to be received. So we are discussing income deemed to be received in India. Employer's contribution to RPF in excess of 12% of salary. If employer contributes 15%, then 12% can be claimed exemption, balance 3% even though not received, we treat it as received in India. This is deemed to be received, first point. Now let me continue this. Whenever point comes, I will show you. If employer contributes to unrecognized provident fund, here also exemption is given. Sir, why you are giving exemption? Initially we will give exemption, but upon withdrawal this will be taxable. Contribution is given exemption. Even though you are contributing to employees provident fund, employer is contributing, it is exempted. But upon maturity, lump sum payment from URPF, in future this will be taxable. So let us control our emotions to tax this URPF. Simply we have to say that it is exempted till here. When this will be taxable? Future, at the time of receipt we will see taxability. Coming to the fourth one, employer's contribution to public provident fund. He will not contribute. Public provident fund, we have to contribute on our own. No person will contribute. Here employer, in case of employment, any of these three, they will contribute. Employer's contribution towards SPF is fully exempted. RPF is exempted up to 12% and URPF is also exempted. Sir, here RPF, there is one more additional rule. Since the topic has come, let me have a discussion. Another aggregate cap of 7.5 lakhs is fixed. Let us see example. Basic salary 20 lakhs, basic plus DA. There is no commission, fixed percentage of commission. Basic plus DA is 20 lakhs. Let us continue. Employer's contribution is 12%. Employer's contribution is 12%. So 2,40,000. Tax status, since it is exactly 12% and it was below 7.5 lakhs, 2,40,000 is only the contribution, then entire 2,40,000 is exempted. Till here we have already learned. Now let me continue. When salary is 80 lakhs and employer's contribution is 9,60,000, that means here contribution is greater than 7.5 lakhs. It might be within 12% limit, but here maximum cap of 7.5 is fixed. How much additionally you have given in this case? 2,10,000 will be added to the salary. That means this 2,10,000 will be deemed to be received in India. Am I clear, sir? So here 2 points have been specified here. First thing, up to 12% you can claim exemption. More than that 12%, if anything is contributed, will be taxable. Even though it was within the limit of 12% and the contribution is greater than 7.5 lakhs, that contribution will also be taxable. Okay. So by this we have completed. This first point I have completed. Employer's contribution is completed. Number 2, employee. Sir, will employee additionally contribute or will he pay out of his salary? Employee. Will he make additional contribution or will he pay out of his salary? He will pay out of his salary. That's why salary is already been taxed under the head salary. Now out of that salary, when he is giving any contribution, we have to give deduction. Whether the deduction is eligible or not, that we need to discuss here. So here employee contribution towards SPF, you can claim deduction under section 123, New Income Tax Act. Old Income Tax Act 80C. In new section 123 is the section. It was specified in schedule 15. It was specified in schedule 15. The list of items where we can claim 80C deductions. That means now section 123 deductions were given in schedule 15. Sir, you said chapter 8. No, chapter 8 is the section. Section 123 is given in chapter 8. But the list of items where you can claim deduction, schedules will be given. 16 schedules I have said, no, in which 15th schedule has specified that contribution towards SPF can be claimed as deduction. Contribution towards RPF also can be claimed as deduction. Sir, but one thing to be remembered here is, if you are opting new tax regime, again these deductions will not be available. These deductions are available only for old tax regime. Next, URPF, you cannot claim deduction at all. Since you are contributing, why you are contributing to URPF? You can contribute to PPF now. It is at your wish now. That's why employee's contribution cannot be claimed as deduction towards URPF. Sir, this one then again upon maturity we have to give exemption, because here we are not giving deduction. Here we are giving exemption, so upon receipt this will be taxable. Here we are not giving deduction, so this amount upon receiving upon maturity this will be exempted. Those things we will listen, sir. Just wait for few minutes. And PPF also can be claimed as deduction under section 123. But if you opt new tax regime, then again not available. Till here is it okay? Now let me continue my discussion. Interest credited every year on employer and employee contribution. Sir, here both employer and also employee both are contributing. Every year on the fund which is contributed, interest will be accrued. Whether that interest is exempted? Yes. Towards SPF exempted, towards RPF up to 9.5% if employer pays interest, it is exempted. Sir, can employer pay 11%? Yes. But in hands of employee, difference of 1.5% will be taxable. Sir, did employee receive the interest? No. Only interest is credited. Even though he is not receiving the interest, this will be deemed to be received in India. This is the second point. I hope why I am first explaining Provident Fund topic, I think you got clarity now, because many of these points refers Provident Fund. So, interest credited in RPF in excess of 9.5% will be deemed to be received in India. Sir, am I clear? If can employer pay 14% interest on Provident Fund? Yes. But 4.5% will be taxable under the head other sources in the hands of employee. It will be deemed to be received in India. Okay. And one more special point is there. Even though within the limit of this 9.5%, if it is towards excess contribution, what is excess contribution? You have already specified earlier. Now again let me give clarity. Excess contribution. $7.5 lakhs I have set to limit, internal limit, maximum cap. Here additionally 2,10,000 is contributed. Is this 2,10,000 taxable in hands of employee? Yes. And on this 2,10,000 if you receive any interest, this interest is also taxable. Sir, on this 2,10,000 we are receiving only 9% interest. Even you are receiving 9% interest, that 9% will be taxable. We cannot claim exemption because it was towards excess. It was towards excess. Interest credited to employer's contribution is exempt up to 9.5. But if employer contributes more than 7.5 lakh, then interest or dividend earned on that specific excess amount is also taxable. This is what the important thing here. Sir, hope I am very clear to you. Now let me continue my discussion. Sir, by this what we have listened here is statutory provident fund, so interest, statutory provident fund interest is exempted. And next RPF exemption up to 9.5% per annum. URPF also exempted. But let us control our emotion. Even since it is URPF and not been received right now, we are giving exemption. In future at the time of receipt, what we will do? We will tax it. And PPF interest is also exempted. But for this statutory provident fund, there is a limit fixed in schedule 2. Generally, statutory provident fund, recognized provident fund and public provident funds are exempted from tax. Interest income from those provident funds are exempted from tax. Even schedule 2 of New Income Tax Act also specified the same. But from 2021 onwards, even in old act also this change is there. What was given there? If in every year you are contributing more than 2.5 lakhs, you are contributing more than 2.5 lakhs. Of course, for RPF, a specific limit of 7,50,000 is fixed. But for remaining, if you are contributing more than 2.5 lakhs, then on the excess amount over 2.5 lakhs, interest received will be taxable. Actually, what I have said to you, interest is exempted. Actually, interest is exempted, but here interest will be taxable. Let us go through an example so that you can understand. Rahul works for a private company. In financial year, his own contribution to Provident Fund is 4 lakhs. What is the threshold limit fixed by us? 2,50,000. Since he is contributing 4 lakhs, on excess amount of 1,50,000, excess amount of 1,50,000, if we receive interest at 8.5%, 8.15%, this will be approximately 12,000 amount, will be taxable under the head other sources. Full exemption cannot be claimed. But in case of government employees, where employer also contributes, here if you see, if employee is contributing, then there is no contribution by the employer. If there is no contribution, that means here both employer and employee are contributing. But if there is no contribution by the employer, then what happens in this case? That 5 lakhs will be taxable, over and above 5 lakhs. Here the limit, instead of 2,50,000, 5 lakh limit is been given here. So Priya is a government officer. She contributes 6,50,000 to general in the sense statutory provident fund. In an year, her employer does not make any matching contribution. Now what we need to see here, in excess of 5 lakhs, how much is deposited? 1,50,000. Interest received on this 1,50,000 will be taxable. Interest earned up to 5 lakhs will be exempted. Are the limits clear, sir? That's why examples I tried to give, so that in future also, even though we forget the provision, so we can see this example and remember. That's why these examples were provided in the material. The material is available in the description box. Anyone who wants it can go through it. Now let me continue. Now coming to the future, lump sum consideration. Lump sum in the sense, at the time of maturity we receive both retirement or maturity, whatever may be, if we want to withdraw. So Provident Fund will be received along with the interest. Statutory Provident Fund exempted, no limit. Statutory Provident Fund lump sum consideration future receipt is exempted, because every year interest amount we are taxing, no. Excess contribution interest is already been taxed. That's why future exempted. Income from RPF is also exempted. URPF, here comes the point. Initially employer contribution I have given exemption. So the contribution, employer's contribution future I am getting back, that will be taxable. Interest also will be taxable. Interest also I have claimed exemption earlier. That interest also will be taxable. It will be treated as a perquisite, profit in lieu of salary under section 18. This will be taxable. New Income Tax Act section only, section 18. Coming to second part, employee. Here if you see, both employer contribution and employee contribution also will be received. Employee contribution we didn't claim deduction earlier. So the contribution now will be exempted. Earlier I didn't claim deduction means it has already been taxed. That's why now this is exempted. Coming to the next one, interest received will be taxable, because here interest I have taken full exemption on both the contributions. That why here interest will be taxable. But under which head? Other sources, since it is employee's contribution. Employer's contribution will be taxable under the head salaries. Employee's contribution will be taxable under the head other sources. So till here is it okay? But here we have a special point for RPF. Minimum 5 years employment should be there. Below 5 years of employment, if Provident Fund is withdrawn, this will be taxable. But if it was withdrawn due to ill health or contraction or discontinuance of employer itself has closed the business, I didn't resign, employer only have closed the business, or any other cause beyond the control of the employee, then it will be exempted. Sir, greater than 5 years, it will be exempted. Less than 5 years, if for cause beyond our control, will be exempted. No sir, I am only withdrawing, then in this case, that will be taxable, but that will be taxable. But here if you see, is balance standing, if it was transferred to the new employer, have resigned this job and have went to the new job and PF amount has been transferred from there to here. In this case, if you are transferring the account to the new employer, then it is exempted. Only if you withdraw, then only it will be taxable. Even from pension scheme also, if you withdraw the amount, this will be taxable. But if you transfer to the new employer pension scheme, then this will be exempted. If no such transfer is made and I am directly withdrawing, means this will be taxable. This is what the flow chart is explained. So till here is it okay? Now income deemed to be received. We have begin that topics are actually in that income deemed to be received. We have discussed 2 points: contribution to RPF in excess of 12% of salary, interest credited to RPF in excess of 9.5% per annum. These 2 topics we have discussed. Now coming to the third one, sir, initially it was URPF. The conditions imposed by the Provident Fund Commissioner were not satisfied, but now it has got the status of RPF. Now the conditions were satisfied. It took 2 years, for example, it took 2 years to get converted from URPF to RPF. Then what happens in this case? Then the transferred balance shall be taxable. Whatever the balance is being transferred from URPF to RPF, till now this is URPF. That's why this will be taxable now. Sir, I am not receiving, no, it is just converted into RPF. Even though you are not receiving now, the transferred balance, because in future you say RPF received exempted. That's why we will not wait till future. Now only at the time of transfer from URPF to RPF, now itself we are going to levy the taxes. That is nothing but income deemed to be received in India. So the transferred balance from URPF to RPF will also be treated as deemed to be received in India. And one more deemed to be received: contribution to pension fund by employer under section 124, earlier act section 80 CCD, earlier act section 80 CCD 2. Deduction is available up to 10% of salary only. Deduction is available up to 10% of salary. Sir, what if employer contributes to pension fund 13%? Then in this case, deduction under 80 CCD 2 will be restricted to 10%. Even in new regime also this deduction is there. I have already intimated you. This deduction can be claimed for new regime also. In past session, section 202 at the time of discussion we have taught this. This balance 3% will be taxable now. This balance 3% will be taxable now. Even though this 3% is not received now, even though it is contributed to pension fund, we deem it as received in India. Sir, am I clear? So 4 points were already been underlined here, and the last one is deemed dividend. Even though we are not receiving the dividend, there are some deemed dividend provisions. In old Income Tax Act, it was 222A to E. Here it was 240A to E. These deemed dividend provisions we will discuss in the chapter other sources, sir. But here what you need to remember here is deemed dividend, even though not received, will be treated as received only. That's if to remember that A to E points we will discuss in income from other sources. So by this 5th point got completed. Sir, what we have discussed here is now what I have discussed to you here is income deemed to be received in India. How many points were there in this? 5 points were there. These 5 points I have discussed to you. Okay. So now let us go for next one. So what is the next point? Income deemed to be accrued in India. This is very big topic for discussion, but we have to discuss. That is what the residential status importance this chapter. So we have to discuss. Let us start our discussion of income deemed to be accrued in India. This is only the last topic, but this is a big topic, but which cannot be completed immediately, but we will try to do it. So income deemed to be accrued in India. What do you mean by the term income deemed to be accrued? These aspects we will discuss. First things first, here income from business connection. That means if you are doing any activity in India that leads to profits, you set up a branch in India, you set up a depot in India, you appoint an agent in India, that means exclusive our agent only he is. Whatever we do, he will on our behalf, he will secure the orders, on our behalf, he will maintain the stock. Whatever the instructions we give, recover from that creditor, you give discount to that creditor. He concludes the contract based on our discussions. In that case, business connection is in India. That is nothing but agency. Next, service center is in India or factory outlet in India. Sir, here what is there? Here is something is in India. What is that something is called is PE. PE means permanent establishment. PE means personal establishment. So here personal establishment is there in India. Personal establishment is there in India. So whenever there is permanent establishment. There is permanent establishment in India. Whenever there is permanent establishment in India, that profits we deem to be accrued in India. You might say that, sir, this is a branch of a foreign company. Foreign company is incorporated in Australia. In Australia, it is resident. So this branch profits also will be taxable in Australia. So please live in India. We can't say like that. Since you are having a branch in India, we deem that, you might say that, sir, controlled from outside India. Whatever the reasons you say, we don't bother. We deem that it was accrued in India. Sir, there also they are levying taxes. Then you have to go for DTAA. It's a separate thing. But here first we need to tax it. Sir, here what is there in India? Very simple aspect, sir. What is there in India? Business connection. Business connection means any activity in India that leads to profits. For example, branch, depot, agency, service center, factory outlet. You are establishing a permanent establishment in India. Not only one side, it might be rented, whatever may be. You have an establishment in India. There you are doing the business. That's why that profits will be taxable in India. Yes. How? It will be treated as deemed to be accrued in India. If you remember, this is which category? Deemed to be accrued? Category number 4. First 4 categories, if you remember, is taxable for all the SSEs. So even for non-resident, the Indian branch profits, you have to pay tax in India. If you are liable to tax at foreign country also, then DTA benefits have to be taken. Till here is it okay? So here what is there in India? Once again I am asking, sir, what is there in India here? Business connection is there. Business connection by way of permanent establishment. So for a non-resident, for resident generally all incomes were taxable now, Indian accrued incomes, that's why I am focusing on non-resident. So for a non-resident, when there is business connection, that means permanent establishment, we call it as PE. When there is permanent establishment in India, then the income of that PE will be treated as deemed to be accrued in India. Till here it is okay. Now coming to the second part. Even though there is no business connection, even though there is no permanent establishment in India, but if there is significant economic presence. Where this is the significant economic presence, it is in India. I call it as SEP from now onwards. If that significant economic presence is in India, then also we treat it as deemed to be accrued in India. So here, which term we need to learn now? Which term we need to learn? Permanent establishment, just now we have already discussed. So now what we need to learn here? The term significant economic presence. This significant economic presence has been defined in section 9 of New Income Tax Act, or also Old Income Tax Act also. Section is same, but subsection will be different. Now let us discuss this concept of significant economic presence with very live examples. Sir, did you understand the importance of significant economic presence? Even though there is no branch in India, all the services were provided through online or emails or WhatsApps, whatever may be. There is no presence in India at all. But even though there is no physical presence in India, that means there is no permanent establishment in India, you are having significant economic presence. Now what do you mean by the term significant economic presence? We need to learn 5 special points we are going to learn. Let us begin. This is what important aspect today, sir. A non-resident having a significant economic presence in India. Please listen carefully, sir. This takes time for understanding, but many of the clients question this one because their relatives might be located outside India. They might want to do business with a person in India, but they don't want to set up a branch. But through this person in India, they might do the business. So whether it is taxable or not, they will ask suggestions from us. That's why we need this point. Transaction in respect of goods, services, property by a non-resident, including downloading of data, software, if the aggregate of payment exceeds 2 crores. Word to word, I have given example for each word. You can easily understand. Let us begin. First point I am explaining, sir. Goods. If you see, a luxury, I will explain with the example directly. A luxury watchmaker in Switzerland. Sir, where is the watchmaker? He is at Switzerland. He is selling watch directly to the individual consumers in India through global website. That means they have maintaining a company website. In that website, if I am going to book a watch, sir, this watch, for every watch they have profit of 10,000 rupees. Let us assume in rupees they are getting 10,000 rupees profit for every watch. Whether this profit is taxable in India. Sir, if they set up a branch in India and sell the watch to the Indian persons, now what happens? Whether that branch profits are taxable or not? Yes. But here they are not set up any branch. They are selling through their website. But, sir, actually when they sell to the website, why should we tax them, sir? But if the total sale to Indian customers exceeds 2 crores, then the watchmaker will be treated as having, what is this? Significant economic presence in India. The profits attributing to these 2 crores, the profit attributing to those value greater than 2 crores is there now. If your turnover is 3 crores, then we assume that there is significant economic presence in India. So for that 3 crores of turnover, if you get profit of 4 lakhs, this 4 lakhs is taxable in India. Sir, I didn't set up any branch in India. I didn't set up any agent in India. I am selling through my online website. But to whom you are selling? You are selling to the Indian customers. And the turnover is significant. Significant means greater than 2 crores. That's why we say that you are having significant economic presence in India. So what? If you are having significant economic presence in India, the income shall be deemed to be accrued in India. So even online websites is selling the products to India also, if their turnover is greater than 2 towards sale to Indian customers, then on the profits arising they are liable to pay. If there is no section like this, there will be no tax at all. But nowadays, rather than physical presence in India, these online sales were only been improving. That's why to trigger these aspects, we have initiated this concept of significant economic presence. Sir, significant economic presence, for our understanding sake, whatever topic is completed, that I will underline. Okay. Here, goods point has been completed. Online sale of goods. When it will be taxable, sir? When the turnover in India exceeds, turnover to Indian customers exceeds 2 crores. Next, coming to the services. This includes any intangible benefit provided to a person in India, whether delivered digitally or otherwise. See an example, sir. Unless example is there, we can't understand these terms easily. An independent architectural firm in UK, architect, sir, who draws the plans, building plans, he is in UK, United Kingdom, provides building designs and 3D models to Indian real estate developer only through email and video calls. Sir, did that architect come to India? No. We are sending our land details through email. We are explaining what type of project we need through video calls. And he has sent the project designs in email. Everything is online. We didn't go there, he didn't come here. He is not having any branch in India. Till now, if you say what will come to a conclusion? Nothing is taxable in India. But if his fees from all his Indian clients, that architect, sir, if he is receiving fees from all the Indian clients in total greater than 2 crores, then it will be said to constitute significant economic presence in India. Am I clear? Not only for this one design. If that entire turnover of that architect during the tax year provided to Indian clients exceeds 2 crores, then that architect will be said he is having economic presence in India, and the profit on this 2 crores, if the profit is 15 lakhs earned after expenses, then this 15 lakhs will be taxable. Am I clear? Now coming to the for each point after completion, for every point I have given example. Goods have been completed, services have been completed. Now coming to the third point, property. Everything will go with example only. A Japanese company owns the trademark for a popular cartoon character and license the right to use this character on t-shirts. They have a special cartoon character. They have designed a new cartoon character. They have taken license also. To print on a t-shirt by an Indian manufacturer, they have given right to use that logo. Right to use that cartoon. Right to use means it's an intangible asset, nothing but a property. That right to use is given for which royalty payment is received. If this royalty payment exceeds how much? 2 crores. From all the Indian garments manufactured in total, whatever in entire year you are charging to Indian customers, if it exceeds 2 crores, then this royalty will be taxable. How you are saying this will be taxable? We assume that your significant economic presence is in India. So, in India, through online only, you are not coming to India, or that person is not coming to India, you are not going to India. But everything, goods were being traded, services were being provided, right to use is being given. When your turnover is greater than 2 crores, then we will tax it. And coming to next one, including downloading of data. For every point I have given examples, sir, for understanding sake. So now let us see the term. What do you mean by the term downloading of data? A financial research firm in New York sells the access to a massive database of global stock market trends. So financial research firm, where it is there? In New York. Indian investment firms pay a subscription fee to download these data reports, so that where to sell our product, statistical analysis can be find out. So we are paying subscription fee for downloading the data, global market trends, what are there. So we are paying subscription fee and downloading the data. If this subscription fee received from all the persons is greater than 2 crores, then that research firm, we will deem that significant economic presence is in India, then we will levy tax on that membership fee, subscription fee. Next. So downloading of data is completed, and next downloading of software. Software also same thing. An Australian company develops a specialized video editing tool. Indian freelancers are making the payment and downloading the software on their computers. Everything is online. But here, for this we are paying fees. If this fee is greater than 2 crores, not only from us, from the total persons who are total Indian customers, if you receive greater than 2 crores, then significant economic presence is in India and will be taxable. So till here is it okay? So first point got completed. If the aggregate payments, all these 5 cases are 1, 2, 3, 4, 5 we have completed. All these cases, aggregate of payments for such transaction should exceed how much I have said to you? 2 crores has to be exceeded. So till here we have completed. Now let me continue. Second point. This was based on users. How much you are receiving is not criteria. You will receive indirect income now. But number of users are more than 3 lakhs. Or what is this users? Let us see. Systematic and continuous soliciting of business activities. I have given example. A foreign mobile app company runs daily targeted notifications, weekly letters, consistent algorithms. All these services were provided by them. To whom they are providing these services? To Indian users. So if the number of users are greater than 3 lakhs, they are providing daily notifications, weekly newsletters. Everything were provided online only. But if the number of users are greater than 3 lakhs, then whatever fee is charged by this foreign mobile app company, that will be taxable in India. We assume that they are having significant economic presence in India. Very special topic, sir, this one. Even though not useful for our routine practice, to suggest to our clients, when they ask any suggestions for us, we can answer them easily. Now coming to the next one. Engaging in interaction. Like a call center, we can take example. Engaging in interaction with more than 3 lakh users. That example also I have given. Soliciting the business activities. Engaging in interaction. A global media, social media platform or search engine provider that allows Indian users to create profiles, upload content, interact with other users. Even though it is free, to Indian users they are providing interaction facilities through online, for which they charge a fee. Here fee is not important. If their number of Indian users, are greater than how many users? 3 lakhs, then it will be deemed to be accrued in India. Significant economic presence shall be deemed to be in India. Here if you see another example, an international cloud storage provider offers 5 GB free space. So 5 GB free space is given. But 3,50,000 users have come here. So for this 3,50,000 users means greater than 3 lakhs. Hence the significant economic presence will be deemed to be accrued in India. Some people might use more than 5 GB and they will pay the fees. That fees will be liable. Here 2 crores limit is not there. Whenever number of users are greater than 3,50,000, then this will be taxed. So by this, we have completed the second point. First and second point examples, with examples we have discussed. Now coming to third point, advertisement services, very, very important. Earlier, a concept of equalization levy, indirectly TDS, 6% is there. But that equalization levy is omitted from 2024 because this concept of significant economic presence has come now. What they have specified here is, let us go through the example. A social media company based in US. It was in US, social media company. There is no office in India. If there is office in India, we don't want to come for significant economic presence. We can directly say that there is business connection in India. So if there is no office in India, then only we are discussing these aspects. But they allows a global shoe brand to run the ads. These ads are specifically programmed to appear only for users logging from IP address in Mumbai and Delhi. Sir, if we, let me take a basic example. If we are opening YouTube, sometimes ads will come. Like that, there will be many portals, Facebook, Instagram. If they are having server or any place of business in India, then we are taxing. But their entire servers might be established outside India. From outside India only they are providing advertisement services also. Whether that advertisement services will be taxable? Yes. How that will be taxable? If their turnover greater than 2 crores or number of users were greater than 3 lakhs, then we are going to tax it. So what they are telling here is advertisement services also will be deemed to be significant economic presence in India because the target customers are in India. Next, sale of any Indian user data. Next point is there. Fourth point. Sale of data collected from Indian users. If in India they are collecting data and selling to other person, that selling services also will be taxable. A free weather app based in Singapore collects location and preference data from 5 million users in India. Their feedback has been taken. 5 million users are there in India. This information, this free weather app, this information is being sold to Indian marketing research firm. This income will be taxable. Significant economic presence. 5 million users are in India. More than 3 million users in India means we deem the significant presence is in India. Next. And next one is data driven services. Electronic commerce platform also they can use. Electronic platform like Flipkart. So Flipkart, let us assume this was outside India. Supplier, that means seller, buyer. Seller is outside India. Flipkart service is also outside India. But buyer is in India. So since you are selling the goods in India, we create an account in Flipkart. Everyone has an account in Flipkart or Amazon. Unless we have account, we can't enter the delivery address. No? That's why. We usually have account based on our phone number or email ID, whatever may be. So if these users were greater than 3 lakhs or if the sale of product through e-commerce platform greater than 2 crores, then this will be treated as significant economic presence in India. Upon this sale transaction, profit on sale will be taxable for supplier. And Flipkart is going to receive commission here. This commission is also taxable because significant economic presence is in India. See how much depth is there in this concept, sir. To an electronic commerce operator, protocol address based on IP internet facility we are booking. That's what has been given here. Last 3 points only, again theoretical discussion is given. First of all, we need to see 2 crores and 3 lakhs limit. Any case, total 5 points we have discussed. Here 2 crores and 3 lakhs, nothing, no limit has been touched here. Then in that case, nothing will be taxable. First we have to check whether this criteria has been met or not. These 3 have been given in clause G, section 9. Okay, that's what clause G acts as a filter. First this 2 crores or 3 lakhs limit has to be satisfied. Then targeting ads, sale of data, data driven sales, all these also will be taxable. Sir, am I clear? What I have explained here, the concept is the concept of significant economic presence in India. Having a significant economic presence, this is, I have set this as point number 9. Total, we are in the concept of income deemed to be accrued in India. total 9 points were there, 8 were old and 1 new significant economic presence. Total 9 points were there in income deemed to be accrued or erased in India. Out of those 9 points, we have basically discussed 2 points. One A regarding business connection. If they are having branch in India, we have discussed. If there is no branch in India, point number 9, significant economic presence, we have discussed. Till here, is it okay? Now let me continue my discussion. Income deemed to be accrued in India. What are other special points here? If you see, there are some exceptions to the concept of business connection. That means there are 7 points which were specified here. Sir, through online, there are 7 points. Okay, let me explain one by one. Total 7 points were given. In these 7 points, there is business connection. There is business connection. Generally, if there is business connection, taxability arises. If there is business connection, taxability arises. But in these 7 cases, in case of non-resident, even though there is business connection, nothing is taxable in India. Nothing is taxable. That means exceptions to the concept of business connection. So, nothing shall be taxable in India in these 7 cases. What are those 7 cases? Let us see. Once again I am saying, sir, in these 7 cases, is there business connection in India? Yes. Usually when there is business connection in India, we tax it. But for these 7 cases, even though there is business connection in India, we are not taxing. What are those 7 cases? Number 1. Sir, sale through agency, we say connection is in India. But if this agent is an independent agent, sir, where agent is there? Agent is in India only. Through him only, we are securing orders, maintaining stock or concluding the contract. But he is an independent agent, means he does these services not only for us. For many persons, he offers the same service. That means he is an independent agent. If we appoint a sole selling agent for this purpose, then we deem the business connection is in India. But when there is an independent agent, then nothing will be taxable. He sells not only our company products, he sells other company products also, that agent. He is an independent agent. Even though there is business connection in India, nothing will be taxable in this case. I am not asking regarding agent commission. Company is selling the product through agent in India. Company profits were not taxable. That's what I am explaining here. Next, very, very important point, sir. Any person purchasing from in India to export out of India. A person in US is purchasing some goods from India and selling to Australia. Even though purchase is made in India and sold from India to Australia, here what is the business connection? Means purchase activity is there in India. Even though purchase is made in India, here indirectly export to our country. We are exporting to US and US is exporting to Australia. Since we are exporting to US, nothing to encourage this one, foreign currency will be realized to India. To encourage this one, exemption has been given. Next one. In India, just a collection of news has been done and published in foreign newspaper. That means Indian news collection is done by the agents in India and these agents are giving the news to foreign newspaper. Here even though collection of news is there in India, Indian news should be presented in the foreign newspaper. Then only investors will come to India. That's why even though news collection activity is there in India, that foreign company newspapers any profit is received, whether that profit is taxable in India? No, nothing is taxable because only collection of news activity is being done here. And next, shooting of cinematograph films in India. Shooting of cinematograph films in India. If any foreigner, any non-resident shoots any film in India, even though shooting is done in India, since Indian locations will be promoted abroad, Since Indian locations will be promoted abroad, what they have specified here is that shooting, even though conducted in India, the film profits will not be taxable at all. Shooting of a cinematograph films in India is not taxable. This is exception number 4. And exception number 5. We need to understand this exception number 5. A separate topic has been given, like a mutual fund. Some members who are non-residents have formed a fund. This fund is a non-resident. Some members have formed a fund and this fund is a non-resident. Such fund, on suggestions given by the fund manager, it is investing in shares or debentures of foreign company. It is investing in shares or debentures of foreign company. Sir, actually there are 25 members. Example, they formed a fund. This fund is invested in shares and debentures of which company? Foreign company. My first basic doubt. Who are the members? Non-residents. Where the fund is formed? Outside India. Where the fund is invested? Outside India. Upon this investment, on shares dividend will be received and on debentures interest will be received. This interest and dividend is also received outside India. Then why we are taxing in India? Because fund manager who is giving suggestions, he is in India. Based on his skill only, the income is being received. Even though fund is formed outside India, even though the shares or debentures investment is made outside India, even though dividend and interest is received outside India, why these entire activities have done? Because of fund manager presence in India. So this will be treated as business connection in India. Now this funds dividend and interest, is it taxable in India based on concept of business connection? Yes, but it has been given an exception. That means we have to promote this fund manager. There will be many fund managers across all over world, but they are selecting fund manager in India means he is skilled. He is skilled means our Indian reputation will develop. So keeping that in view, the dividend or interest earned by the firm usually may be taxable because the fund manager is in India. But however, nothing shall be taxable. However, nothing shall be taxable because it was given in exception. But on two conditions, fund should be eligible fund manager should be eligible fund manager. For him, remuneration 20% of the profit should be given, because here Indian currency, foreign currency should come to India. That's what is important here. His remuneration, how much has been specified here? 20%, not more than 20%. Below 20% remuneration should be received. Some conditions were given for fund manager, some conditions were given for fund. Sir, this is not relevant for our individual practice, but since topic is there, we are discussing that. These are the conditions, 13 conditions were given. It will be taken care by that fund. We need not discuss them. But if this fund is eligible fund and fund manager is eligible fund manager, even though fund manager is in India, the profits in the sense dividend and interest shall not be taxable in India. Nothing shall be taxable. That is what has been given. This is exception number 5 to the concept of business connection. Here if you see, presence of an eligible fund manager in India not to constitute business connection, discussed in page number 15. That's what we have discussed till now. Coming to the next one, income of a foreign diamond mining company. They are just displaying the diamonds in India. They are not selling. If they sell the diamonds in India, it will be taxable. They are just displaying the diamonds in India. They are taking the orders and from foreign location they are supplying. Just display of diamonds in India is not taxable. Most specifics are not relevant for our practice. Since the concept is there, we are discussing. Next one also same. Crude oil reserves were established in India because number of imports, crude oil is very important for our petrol and diesel. Rather than importing them again and again and travel cost is higher, they are going to lay out the pipelines from that country to this country, pipelines, they are going to supply this petrol and diesel. In this case, crude oil. When oil reserve is maintained in India, that oil reserve, to encourage this crude oil, which is very important to us, income from sale of such crude oil at the reserves maintained in India is exempted under New Income Tax Act, Old Act 1048, and now here it is section 11, schedule 4. Income Tax Act, total 16 schedules I have specified, in which schedule 4 has given this point. Even after the expiry of their agreement period, stock left with them is sold is also exempted. 1048B is the old exemption. Now it was section 11, schedule 4. So till here is it okay? Last, these exceptions, sir, were most specific, not useful for our regular practice, but since topic is there, I have tried to explain to you. Next, sir, we are in the topic income deemed to be, we are in the topic income deemed to be accrued in India. Now let us go for next. So there are 15 more minutes the session takes. There are some balance topics and most important topic like gift also. So it takes 15 more minutes. So let us focus on this aspect and conclude this residential status. So salary received outside India for services rendered in India. Sir, where the salary is received? Outside India the salary is received. But where I have rendered the service in India? Since the service is rendered in India, they said that income deemed to be accrued in India. And there are two more points here. Property located in India. A non-resident is having a property in India. Out of this Indian property, any rent is received. Is that rent taxable? 100%. Because the property is in India, even though you are a non-resident, we deem that it is accrued in India. And on transfer of that property, if you are getting any capital gain, that will also be taxable. On transfer of property, if you receive any capital gain, that will also be taxable. There is a special case which will be discussed at the end. Let me conclude this one first. When government of India is paying salary, you should pay tax in India only. Even though you are rendering service outside India, even Indian government needs some services outside India. Even though you are working outside India, your salary is paid by Indian government, this will be taxable. Next, dividend payable by Indian company, even though they are paying to non-resident outside India, since dividend is declared and paid by Indian company, that dividend will be taxable. Okay, next very important thing, interest, royalty, technical fees, common point here. Sir, generally interest is an expense for borrower, interest is income for lender. So for this lender, that means who have given the money, for him interest is taxable based on the borrower, that means payer. If interest is paid by government of India, if interest is paid by the government of India, then it is taxable. You might be ROR, RNOR or NR. I have explained you these three topics. If it is payable by government, then it is taxable. If interest is paid by resident, that means this borrower is resident, then in hands of recipient this will be taxable only if that resident has used the fund in India. Sir, if he has used fund outside India, then we will go for category 7. Now we are in category 4, income deemed to be accrued in India. If it was used outside India, then it will be, it has other income accrued and received outside India. category 7 is taxable only for ROR. And next, if this interest is payable by non-resident, that means borrower is a non-resident. In this case, this non-resident has to use for business purpose in India, not any purpose. Here, any purpose in India. But if the borrower is a non-resident, he should use it only for business purpose in India. Then only receiver ROR or RNOR or NR, this will be taxable. Sir, if it was used for other purpose in India, then it will go for category 7. Category 7, if you remember, taxable only for ROR. Total 8 categories of incomes I have explained you already. Sir, is it clear? Now comes the most important point. Gift by resident to non-resident. Sir, in abroad, in New Zealand, one of my friend, my childhood friend, is doing a job at New Zealand. So now what I am doing is, I have gifted 10 lakhs of amount from my bank account to his New Zealand bank account. Whether this gift given by me, it is my white money only, no problem. The gift who is receiving is a non-resident. But who has gifted this one? By a resident. Then in hands of non-resident, this gift shall be deemed to be accrued in India. Sir, gift accrual, you can see receipt, no. Okay, where did you receive? At abroad. Then you will say it is not taxable. That's why we are saying that it shall be deemed to be accrued in India. So when a resident gives gifts to a non-resident, I repeat, when a resident gives gift to a non-resident, this gift will be taxable. I have given very big example for our understanding. Once this example is completed, one balance topic is left, sir, that I will discuss. Gift. Rohan, who lives and works in Mumbai. He is in Mumbai. Rohan's friend is at London. He is a UK citizen. And he is not a relative at all, because gift from relative is again exempted. That's why. Rohan transfers 10 lakhs. Now what happens? It shall be deemed to be accrued to the friend hands and it will be taxable. Okay. Under section 9, subsection 1, clause 8. Deemed to be accrued. Since the gift amount below 50,000 is usually exempted, gift above 50,000 for a non-relative is taxable. Under the head income from other sources, and very important term, we have to deduct TDS 30%. We have to deduct the TDS 30%. Sir, if the recipient is a sister or spouse, if it is relative, nothing is taxable, or gift received on the occasion of marriage is also exempted. Sir, all the gift provisions, sir, I will explain in section 92, subsection M. In income from other sources, I will explain. Since all of us are in practice, you might remember the limit of 50,000, that's I am explaining. On the occasion of marriage exempted, below 50,000 exempted, above 50,000 will be taxable. Even though non-resident is receiving gift outside Indian bank account, we deem that it is accrued in India and you will be liable to pay tax. We can't say you received in India because it was received in foreign bank account, but we say it was accrued in India. Sir, is it clear? So, one balance topic is left, and one more useful thing for our practice, one thing is there, sir, I need to explain. Yeah, this one. At the time of discussing Provident Fund only, I should have discussed this. Sir, to Provident Fund, both employer and also employee, both will contribute. But from employer point of view, now I am discussing from employer point of view. Employer point of view, is this expense? Yes. Employer's contribution to Provident Fund can be claimed deduction only on payment basis. Old Act section 43B, New Act section 37. If you have to pay this employer contribution before the due date of filing return, then only you can claim PF and ESA contribution as deduction. Very important. Sir, in this before due date of filing return we didn't pay. Next year we have paid. Then on payment basis, since next year you have paid, next year you can claim deduction. Current year this will be disallowed, next year you can claim deduction. This is employer's contribution. Next, employee's contribution. Whose contribution, sir? Employee's contribution. Actually, employee's contribution we deduct from salary. If his salary is 1 lakh, if we are deducting 12,000, we are paying only 88,000 to employee. We are paying only 88,000 to employee. So here what is the journal entry we are going to write? To salary. Salary account debtor. How much? 1 lakh. To, let us name Mr. A as employee. To employee account we are transferring 88,000. To PF payable, Provident fund payable, we are writing 12,000. That means in employer's balance sheet, in liability side, there is PF payable. How much? 12,000 is there. This 12,000 will be treated as income of the employer. Sir, already 1 lakh I have claimed expenditure. I am not asking regarding that expenditure. Here what I am saying is, this 12,000 you have deducted. That means you paid only 88,000. But you have taken 1 lakh expenditure. Why? This 12,000 has to be contributed to the Provident fund. But if you do not contribute to the Provident fund, within the due date of relevant act only, section 29, very, very important. New act only. What has been specified? PF by 15th of the month you have to contribute. ESI by 21st you have to contribute. Sir, actually, employer's contribution you have time up to due date of filing return of income. But employee's contribution by 15th or 21st only you need to make the payment. If you do not make the payment, permanent disallowance, later you make the payment also, deduction cannot be claimed. Now here 12 lakhs will be added to the income. If you contribute on 16th, deduction cannot be claimed. You have to add to the income. Of course, there are various case laws that if there is genuine reason for delayed payment, we have paid along with interest, compliance is there. Like that, there are many Gujarat High Court judgments were also there. Based on that judgments, you might claim it as expenditure, but it's a disputable thing. Strictly speaking on section terminology, whenever your employee's contribution is after the relevant act due date, then you cannot claim it as deduction. Okay. And the final topic of this residential status. So this is the final topic of residential status. First one is very simple. Second one, to some extent we can understand, better to understand, but third one is complex. We should have a free mind to understand this concept. Let me begin. So, transfer of a capital asset situated in India, very important point, sir. Vodafone case law, which brought a 4 amendments in Income Tax Act. 4 amendments in Income Tax Act, 2014 Finance Act. 4 changes have come with retrospective effect from 1/4/1961. Vodafone case. This is Vodafone case. Based on this, since there is no specific provision in law, at that time in Finance Act 2014, 4 amendments they have brought here. Let us understand. Case 1. A Limited is a foreign company. B Limited is also a foreign company. B Limited balance sheet, there is investment in C Limited, which is Indian company. Sir, here, who is holding the shares of Indian company? A, B, C, 3 points I have said to you. 3 companies were there. Who is holding C Limited shares? B Limited is holding C Limited shares. If these shares are sold by B Limited to A Limited, now tell me, is the capital gain arising taxable in India? Obviously yes. Because these are which company shares? Indian company shares. Indian company shares is nothing but a property situated in India. Whenever Indian properties were being sold, the capital gain arising shall be deemed to be accrued or arised in India. because in point 1C itself we have discussed. See here, income deemed to be accrued in India, point 1C, capital asset situated in India, whenever we are selling, this will be taxable. Sir, am I clear? Now let me continue. So first one is very simple, that's what I have said. Directly Indian company shares were being sold, so the capital gain arising will be taxable. Now coming to the second point, Vodafone International Holding Limited, which is a foreign company. Hutchison Telecommunications International Limited, because Hutch has been acquired by Vodafone. So Hutchison Telecommunications Limited, it is also a foreign company. This Hutchison Telecommunication Limited is having 100% investment in CGP Investment Limited, which is a Cayman Island company. That means nothing but a foreign company. Now what happened here is, this CGP investment plus its subsidiaries balance sheet, if you see, they have investment in Hutchison SR Limited, 67% capital. Practically this has been done, sir. 67% capital is in Indian company. Sir, you have said here also Indian company, here also Indian company. Then what is the twist here? Please listen carefully. If the shares of Hutchison SR Limited were transferred to Vodafone, then this will be taxable because Indian company property you are transferring. But here CGP Investment Limited shares were transferred to Vodafone. Which shares were transferred? CGP investment shares were transferred. That means earlier for this 67%, what is the company? Hutchison SR Limited. Is the company closed? No. But in Hutchison SR Limited shareholder register, okay, who is the shareholder? CGP. After transfer, who is the shareholder? CGP only. Because CGP shares were being sold to Vodafone. CGP company is there. They didn't sell Hutchison SR Limited shares. They sold CGP shares. So from Hutchison SR Limited point of view, shareholder is the same. But control is transferred from Hutchison Telecommunications Limited to Vodafone. No? This controlling interest transfer should also be treated as deemed to be accrued in India. So here Hutchison under old Act 195 should deduct TDS. Here shares in CGP were being transferred by Hutchison Telecommunications to Vodafone, which resulted in transfer of controlling interest in Indian company. So by this controlling interest, even though the shareholder is the same, earlier who is controlling HEL? Hutchison. But now who will control? Vodafone will control. Even though the shareholder is the same, but control has been transferred. Directly or indirectly, voluntarily or involuntarily, conditionally or unconditionally. All these provisions have been changed in Income Tax Act. Transfer definition is changed. Capital asset definition is changed. Section 195 TDS, deductor may be a resident or non-resident. 4 sections have been amended with retrospective effect from 1/4/1961. Actually, in Supreme Court case, Vodafone has won. No need to deduct TDS, conclusion has come. But Act has been changed now. Retrospectively from 1/4/1961. Am I clear, sir? So, directly Indian company shares were sold, it will be taxable. Controlling interest has been transferred, this will be taxable. Because Indian company shares control has been transferred. Third one is very extensive. Please see here. A Limited is a foreign company. B Limited is also a foreign company. This is a final point we are discussing for this chapter. A Limited is a foreign company. B Limited is also a foreign company. In the balance sheet of B Limited, there is investment in C Limited. It is also a foreign company. Sir, foreign company shares were sold by a foreign company to another foreign company. Am I clear? So, there is no India at all in this case. Foreign company shares, sir, this C Limited, in first example, this is an Indian company. But here this is a foreign company. So, C Limited shares were sold by B Limited to A Limited. All are foreign companies, non-residents. Why taxation is in India? Because even though this C Limited is a foreign company, it is having Indian assets greater than 10 crores. Sir, this is which company? Foreign company. These shares were being sold by B to A. The capital gain arising to B, is it taxable? Yes. Even though he is selling foreign company shares, that foreign company is having 10 crores value of Indian assets in India. And it is covering 50% of its total assets. Out of total assets of foreign company, 50% of the assets were in India. And this investment by B Limited in C Limited is minimum 5%. For less than 5% negligible, don't follow this concept. Minimum 5% of shares were held by B Limited in C Limited. And assets value greater than 10 crores and it is covering 50%. So finally, what is the conclusion? Even though foreign company shares were sold by a foreign company to another foreign company, that foreign company is having substantial value of assets in India. That means greater than 10 crores or out of total assets 50%. In substantial value of assets is in India, this will be taxable. Sir, am I clear? So this is a complex thing. If you couldn't understand this last aspect, since the video is available here only, please try to again watch the video so that this example can be easily understood by you. In all the three cases, the capital gain arising to the non-resident should be deducted. TDS has to be deducted. In Vodafone case, since TDS is not deducted, that's why the issue has been arised there. So TDS has to be deducted. Section also new section only. TDS provisions we will discuss. Many have been asking me to make a discussion on TDS. All the chapters we will discuss, sir. TDS we will discuss before 31st March only. Along with business or profession, there for expenditure allowances, TDS must be deducted. No? Along with business or profession topic, I will discuss TDS also. Before this month end only, we will have a discussion so that from 1st April onwards, new TDS provisions, new TDS challans, new TDS returns will come into existence. For quarter 4, old returns only. But new deductions from 1st April, so we are going to follow new income tax act. I will discuss TDS provisions also. So today we have finally concluded the entire chapter residential status, beginning with Indian citizen definition to residential status of ROR, RNOR, NR till conclusion of substantial value of assets in India. Entire aspects have been discussed with many practical examples. So hope the concept is very useful to you. So next session we will begin with the heads of incomes: salary, house property, business, capital gain and other sources. So next session we will begin with the salary. Sir, salary, is it useful for our practice? Yes. If new regime TDS is deducted, but if employee wants old regime, we have to calculate now exemptions and deductions. So salary, incomes, entire perquisites and allowances I will discuss, sir. So what is what we need to have a clear picture. So the TDS also deducted based on that. So tomorrow's session we will have a discussion on salaries. Thank you. Thank you.